thank you for being here because it's such a complicated story among the banks these days when provisions are rising, but so is net interest income. So what is it that could throw off the balance between the two and really start to cause a bigger dent in that positive balance that you have right now?
Well, thanks again for having me. I know it's a busy day. Let me just start with with our results. You saw the earnings decline as you mentioned, really because of the impact of the cyclical businesses that we have. Mortgage banking being impacted by rates, rising rates that we've seen over the last couple of quarters. You saw the private equity and venture capital businesses being impacted what we're seeing in the markets. But as you say, the offset to that is really you're starting to see the impact of higher rates impact net interest income. You're seeing loan growth across both consumers and the commercial portfolios, and with that, you're seeing really great credit performance. So you're not seeing the stress appear yet in the credit portfolios, and I think that's been a pretty consistent message across the board. And I would just highlight, as you see credit, the allowance for credit losses increase, the coverage ratio across loans is not changing really, and so that growth in the credit allowance was really just for the loan growth that we've seen over the quarter. So the performance is still really, really strong. Eventually, you'll start to see the impact of higher rates and the slowing economy on our customers, but we haven't seen that stress yet.
Talk to us, though, about the slowdown in the mortgage business that you mentioned, given higher rates, given the path of rates and where we are in the economic cycle. Is that normal, or are you seeing something a little bit different going on that you can't quite figure out?
It's entirely normal. As rates have moved so fast, you've seen really the refinance market dry up and fall, quite substantially in the volumes there. And that's just natural. As rates go up, there's less opportunity for customers to refinance their mortgage. You're still seeing, pretty healthy purchase volume in the mortgage business, although that seems to have slowed a little bit, at least temporarily, and we'll see how that progresses through the year. But I think it's still going to be a pretty challenging market in the mortgage business for at least the next couple of quarters as things start to stabilize. You still have a lot of excess capacity in the industry. You're going to see a lot of competitiveness still, but on the other side of that, you still have home prices still doing pretty well. You have demand for new houses still running pretty high. So there are some offsets to it, but I do think it's going to be a pretty challenging market for the next few quarters.
A pretty challenging market. Let's talk about where the consumer falls in that. When we think about loan growth, obviously up across banks, including Wells Fargo, how long do you think that trend will last? And again, what does that say about the consumer?
Well, the good news is, for the most part, most customers, on the consumer side are doing really well. So they still have a lot of liquidity. Payment rates across the credit card business are really high. You're not seeing delinquencies rise substantially. They may be off the historic lows that we've seen in some products, but they're, in most cases, not anywhere near what we saw pre-COVID. So everything's performing quite well. Now, having said that, you will see some impact from higher inflation and rising rates on customers. You'll see that first on the lower income cohorts. Now, we don't have a lot of exposure in the credit portfolios there, but that's where you're going to see it first. Rising gas prices, groceries, other things that sort of impact day to day, and then eventually that'll start to come up through different cohorts. The longer this environment lasts.
Mike, there's a lot of commentary on Wall Street around these loan commitment write-downs, and you talk to the private equity firms. They say the banks are sitting on their feet, and you talk to the banks, and they say they need to get more cautious in this environment. How do you kind of describe what's going on here and the caution that's behind some of the riskier borrowers on the corporate end of things?
Yeah, it's natural given the volatility that we've seen in the market. We've seen a lot of spread widening in different asset classes, and that's a function of the uncertainty that's there within the market and the overall economy. I think people are cautious about what's coming, potentially coming as you look at the impact of higher rates, and so it's a natural part of the process as you go through an environment like this.
Small businesses, as we know, the bulk of the employers in this country, they're coming out of COVID, taking on additional loans to survive, now trying to pay that back while also now preparing for what could be maybe a recession, even if mild. What are you hearing from those small businesses?
Small businesses are actually performing really well too, and we're not seeing any significant signs of stress there in our portfolio. Now, certain sectors and certain parts of the country will sort of have more of an impact first, but for the most part, they're performing quite well too. I think over the last couple of years, many people have had the opportunity to build liquidity, inventory. They're holding less inventory in most cases than they did pre-COVID, and so far they're performing quite well. But just like on the consumer side, the persistent inflation will have an impact on some of them as we go through the next number of quarters if it persists.
So how does that impact your underwriting standards then? To what extent do you have to exercise caution given the pain some of your clients may be feeling?
Yeah, you really need to be thinking about underwriting standards over a very long period of time and through cycles. And that's the way we've thought about it here for a very long period of time. And so we're not substantially changing underwriting standards, although in the good times and the times of more uncertainty, you're always looking around for those pockets of risk. And as you would expect, all banks are sort of trying to find those areas of risk and make sure that you avoid them. But for the most part, we haven't changed our underwriting standards. And you can see, the performance when you have the right products and right services. You can see that in our card business, where we've been adding new products over the last year and a half, where we've had really good traction in some of those products. The quality of the customers applying and that we're accepting is really high, better than the overall portfolio, and as good or better than what we've modeled. So it really starts with having the products and the right standards, and then really making sure that they persist through time.
Mike, how much room is there to cut more headcount here? It's a tough time. There have already been some headcounts in some businesses. The headcount of Wells Fargo has been reducing quite a bit over time. So what does the headcount look like a year from now?
Yeah, we don't start with headcount. We start with how do you drive efficiency across the firm. And in a lot of cases, that efficiency is either adapting to how our clients are behaving, with us. So, going to a branch less, doing more online. Some of it starts with, downsizing excess real estate and items like that. But then we look at how do you optimize and automate a lot of the things we do for clients, which not only saves money, but also actually provides a much better experience. So it's, making a new account opening process easier, allowing them to get their information faster. So there's a lot of things that we can do. And, we laid out a plan about a year and a half ago to drive efficiency across the whole firm. We're executing on that. We still have a long way to go, but we feel really good about what we've done so far and think there's more to do across really almost every part of the business.